Thanks so much for tuning into this earnings conversation with the management of VST Tillers and Tractors. They were the key. It was a key stock yesterday simply because the company reported the highest ever quarterly revenue of 320 crores. And highest ever revenues is a thing that a lot of companies must be doing, but the growth rates for VST were pretty strong. 47% jump in revenues, PAT up nearly 80% or over 80%. More importantly, EBITDA margin performance also coming into play, with EBITDA margins at about 16.9, if I'm not wrong, versus a usual rate of 13 or usual range of 13 to 14%. Anthony Cherukara, he's the CEO of VST Tillers, joins us right now on the show. Remember, the last time that we spoke to Anthony, he cited this whole Bangladesh-India comparison on tillers and what it could mean for growth for the company. Anthony, I was pretty amazed with the guidance that you've provided to, and I'll come to that in a moment. But first, what went behind the quarter, and is that the sign of things to come for FY24?
Yeah, good morning and thank you for having me here. It has been a splendid quarter for us. The key drivers has not changed. It is the demand for small farm machinery among the small and marginal farmers in India, which form the bulk of farmers, almost 70-80% of the farmers. That continues to be there. The growth will be guided by the ability to reach them, which is through more dealerships, better coverage, better availability of products, and creating more accessibility for them.
Well, you are increasing dealership, right? I think the dealership count pan-India is going up as we speak. So can you give some sense, since you're citing that as a key component, can you give some sense of what it was end December, where it could be end June, and what is the quote-unquote target like going ahead on that front?
So in the last financial year, in the power tiller segment, we increased about 175 dealers. Today we are at about 660 dealers in the power tiller segment. In this year, we intend to add another 175 to 200 dealers. The ultimate aim is to have more than 1,000 dealers for the small farm machinery. Tractor segment, we are at about 350 dealers. Again, if you look at the competitive scenario, most of the tractor companies have 800 to 900 dealers. We also intend to take our network to that level.
And you are foraying into the higher HP segment as well. Maybe we spoke about it briefly in the last conversation, but or maybe it is a new factor that you've just unveiled. Can you talk a bit about it?
Yes, we have largely been in the compact tractor segment, which is only 10% of the tractor industry in India. Now we are getting into the 90% of the segment. So we have a joint venture with Zetor. So the product will be VST Zetor and it will be launched in the H1 of this year. We had unveiled the product in Q4. We have got feedback from the customers. We are tweaking the product to ensure that all the feedback is taken care of and we can launch the product with complete requirements met for the customer.
Anthony, one question on FY24 from an input cost perspective and what it could mean for operational metrics, because just higher sales by themselves lead to better margins, which I believe would have in some part played in Q4. Now, are these the normalized margins for you, and can they improve if the input costs keep on showing a slight declining trend during the course of the year?
Yeah, if you look at commodity prices today, it is somewhere around Q4 prices of FY22.
Okay.
So it is, but it is still not at the levels of Q2 or Q3 or FY22. That is, the September of 2021. It is not there yet. So we expect some more cooling off of material prices to happen, and that should help us with the contribution. Yes.
So your average range, if I'm not wrong, Anthony, used to be 13-14 in the recent past. You've clocked in 16.9, which is virtually 17. Is that the new normal, and would you improve or build upon it?
What I have given as a range in the last financial year was 12 to 14%, and we are very much within the range cumulatively. And of course, there will be seasonal differences quarter to quarter. We are in the agriculture segment, so there is seasons. The scale will definitely benefit in terms of, but cumulatively we'll be in the 12 to 14%. This year we are looking at 11 to 13%. That is purely from an investment perspective. I don't think the contributions are going to change, but it is purely going to be more expenses to get into newer markets, expanding globally.
Okay. Okay. Now, the other thing, did I read it correctly that you are guiding to near trebling of revenues by FY26-27? Even if I take 27, that's 4 years. So you're guiding to trebling revenues from a current circa 1,000 crores to approximately 3,000 crores in 4 years?
Yes, we had set our vision in FY20 for 2025, and then we got hit by COVID. We were at about 543 crores at that point in time, and we got to 1,000 plus crore in FY23. So we have more than doubled the business despite COVID, despite the inflation and supply disruption. And now we are looking at meeting our vision by the year 2026 and achieving 3,000 crores.
Okay. Two things and last couple of things really. One is, what do you reckon could be the risks for the global strategy that you have in mind? I believe you are foraying into Africa as well. You talking about the investments, so some bit of it also factors this international foray. Part one of my question is that. Part two of my question is the increase in the number of receivable days. It's been a fairly steep one, even accounting for all the things that you might have factored in. So what's gone behind that? And are you working on getting those lower?
Yeah. So I'll start with part one. Yes, there is a global expansion happening, and we would be entering the African markets with the introduction of higher horsepower tractors, and there would be a certain expense related to that. And the key risk is to create acceptable products in the market and ensure that the customer understanding is accurate. So we are working on that, and we're pretty sure with the recent launches, which has already been successful, we would be able to do that. Now, coming to the second part on the receivables, if you look at the previous year, we were at about 29 days, and we have ended at about 54 days in this financial year. Now, the bulk of it has been the subsidy sale that happened in Q4, which is the institutional and the government sale. If you exclude that, we are only at about 32 days. And that receivables are already coming in April and May. Some of it has already come in April, and that is coming in May as well. Our intent is to maintain receivables at about 45 days.
45 days, okay. I also read something about the capex for a global tech center. All of this is great news because it shows that the company is really thinking beyond the next 2-3 years. So good stuff there, Anthony. Just one final question, again rolled into two parts. April saw a bit of a hiccup relative to April last year, if I'm not wrong, 23-24% downtick. Was this on account of some one-offs, and will that improve?
Definitely, it will improve. There is definitely, some amount of effect of the monsoon not going to be normal. I think that is kind of, normalized now. People are saying it is going to be normal, and I don't see any reason why the industry wouldn't pick up. And if you see, the whole industry had dropped in April. So we don't see any reason why May and June it will pick up back.
Okay. Fair call. Okay, I buy that argument, but my larger argument is that there is no certainty. You might well continue to see 15 days of May have gone by. If monsoon is going to be, if the monsoon not being good was the factor behind April, the same would hold true for May as well, right?
Sentiments are up now. We are seeing better retails happening in May.
Acha, so May is looking better than what April was looking. Okay.
Yeah.
Okay. My final question, Anthony, and which is, if you indeed, and I'm just asking a follow-up to a question I asked 2 questions earlier. I believe a lot of your international foray, different products, and all of that will go into enabling you to reach this target of 3,000 odd crores or the vision that you have in mind in FY27. Even to reach 2,500 crores, that's a 25% CAGR. You reckon that with the business of the nature that you are in, which is subject to the vagaries of monsoon, so on and so forth, etc., you still will be able to achieve northwards of 25%, nearly 28% CAGR for the next 4 years?
See, if we look at the last 3 years or 4 years that we have traversed and doubled our business, it was not free of disruptions. We had COVID, complete shutdown, we had supply disruptions, inflation. So name it, we had it. So, and the system is more agile. And if you look at our business today, it has become more global. It was more India-centric earlier. Now the growth plans are more strategic, more global, spread across the world. I would say we have de-risked quite a bit, not only in terms of geographical reach, but also in terms of technology and segments that we are serving. Earlier, we used to focus on single dealership channel, which would serve both the tractor and the tiller segments. Now we have separated that out. We have implemented the TOC system of supply chain, which doesn't depend on forecasting, which can absorb shocks, unlike JAT or the other systems of supply chain. So all these put together, I think we are better equipped to deal with disruptions. Yes, the growth plans are ambitious, and the intent was to get the company onto the growth path, which we have achieved. And I think with the projects that we have put in place and on the anvil, which is the VST Zetor, the supplies to electric companies, and the launch of new products, both in small equipment as well as the tractor segment, we are confident that we will be able to chase down that target.
So since vagaries of nature are not a risk, my final question on the interview, since vagaries of nature are not a risk because you're accounting for that, what is the big risk, if any, to these targets that you have?
I think the key aspect is going to be our ability to execute on our plans. And that is critical with the competitive scenario in the country and across the globe. That is going to be critical to ensure that the growth momentum is sustained, the necessary resources are acquired early, because at this growth rate there is a lot of competencies and a lot of resources that we need to acquire to enable it to happen, and the execution of that is going to be the key challenge for us going forward.
Okay. Anthony, good show. Keep it up. Wish you all the best for the quarters ahead, and thanks for taking the time out and speaking to us at BQ Prime.
Thank you. Thank you so much.
The pleasure was ours. Viewers, thanks for tuning in.